Hey folks, welcome to this platform, Business Redefined. As always, any corporate action happens, you have all the detail here, the most comprehensive coverage. And we are on the sidelines of the Acorn DFC Titanic, I should call it, arrangement in terms of financing. And we are privileged, as always, to have the man in charge, founder and CEO, Edward Kirathe. Thank you so much for your time, sir.
Thank you for having me.
Karibu sana.
Yes.
Edward, you are talking about a funding pipeline of close to $1 billion. By my count, about $875 million over an 8-year period, of course. And let's start from here. Explain to us what this financing is about and why it's important for Acorn.
As you know, we've been over the last 9 years building quite a lot of student housing in Nairobi. And today we've got a total pipeline operating beds and developed of about 20,000 beds. But the need for student housing in Kenya is actually quite colossal because just universities alone, we have more than 550,000 students, and only 40,000 beds in the institutions that were built more than 30 years ago. So for all those years, there was no student pipeline. So what we are trying to do is now expand the student housing provision, and this facility will help us to add over the next 10 years or so another just under 50,000 beds, about 48,000 beds, which will take our total to about 70,000 beds. Yeah. Now, each of the buildings you see and that we build, those projects are very expensive. They are multi-billion projects. You know, you see each of our projects costs anywhere between 10-15 million dollars, even some a bit more than that. Yeah. So that's what this funding is coming to drive.
And maybe help us unbundle this financing, because there is a component of, I think, about $180 million from DFC.
Yes.
I've seen there's an arrangement with Stanbic Bank.
Yes.
And there's also a plan to tap more into the capital markets as well. Yeah. About $300 million as well.
Yeah.
Just unbundle it for us.
Okay, so let's start with unbundling it before we deal with the Stanbic, which is the structuring. Yes. And mostly dealing with the currency risk, how you deal with the currency risk. So on the 180 million, 90 million of that will go into the development REIT that we have, the student development REIT, to develop new assets. Yeah. $90 million will go into the income REIT to help the income REIT as it buys assets from the development REIT. I think by now everyone understands that once an asset is stabilized, it is sold to the income REIT, and that's how you build. Now, the 90 million that goes to the development REIT, we can redeploy it up to 2 more times, which actually means that it's 90 times 3. Yes. So that's 270. Correct. So if you add that to the 90, that is around 380 million. Yeah. And now what that will also do is that we will augment that with our local capital raising, which we do annually through the primary issuances for our REITs. Every year, we open our REITs to new investors and also existing investors to continue investing more. Okay. When we launched the REITs, for example, we had 10 pension funds in Kenya that had put in about 1 billion shillings. Today, we have more than 32 pension funds, and collectively they've put in more than 5 billion. And even this year, we will see more participation. And so that capital that they put in will be complemented by what DFC brings to the table. So that's the other portion of it to get us to, it's another 320, that gets us to almost 700 million. And the other bits and pieces, but that's the main component of the funding, which will not come in day one. Yes. Actually, the 180 will deploy it over 5 years, and then, but the facility is 18 years because of that recycling that I talked about. Yes. We can recycle again and redeploy again. So the funding in total, we have up to 18 years, which is good, and the businesses like ours need long-term capital. Yeah. So 18-year type money is what businesses like ours need. The other thing about the DFC funding, the interest rate on that facility are not like commercial banks. This is
it's
concessional funding. Okay. So we take that concessional funding, we'll blend it with the local capital, and that's how we'll continue to build what we do. Now, that is very typical of a business like Acorn if you travel anywhere in the world. And that term we use, which I want to introduce you to, it's called dry powder.
Yeah.
This is committed capital that is not drawn. It's available to you. Yeah. Businesses like ours, for long-term sustainability, you want to build your dry powder. Mm-hmm. So over the next year or two, you will see Acorn building significant dry powder, both for debt and equity. Because then that means that your capital is assured. So if you look at businesses like Greystar or Brookfield or even Blackstone Real Estate, they build quite a formidable amount of dry powder to fund their development. Now, this particular money is specifically for student housing in Kenya.
I see.
Yeah.
Let me piggyback on 2 points there. So the first one is, speak to us about the FX component, because
yes.
When I saw the structuring of the arrangement,
yeah.
I was curious as to whether there was a ceiling as to how much hard currency debt you could take into your books,
right.
and hence the need to have the Stanbic arrangement on the side.
Okay,
yeah.
Not quite. FX is a very, very big risk for long-term investments like housing, infrastructure, etc. You have seen the Kenya debt, what was happening when the dollar was rising.
Yeah.
The cost of servicing that debt was almost becoming unmanageable.
True.
So FX risk is a massive, massive issue because our receipts, the rent the students pay is in shillings.
Yes.
But you have a loan here and it's a dollar loan. So what we needed is to do some intermediation and to de-risk ourselves from exposure to the US dollar appreciation and the Kenya shilling depreciation. So what we did is we then needed an intermediary bank, and that is what Standard Bank role is playing. They are intermediating the transaction so that when DFC give us the dollars, we go to Standard Bank and deposit those dollars in accounts with Standard Bank, and they then give us shillings.
Yes. Yeah.
That are priced competitively, very competitively, because they are sitting on cash collateral. So those dollars, we never get them converted into shillings. That protects us from the risk that the Kenya shilling, which we are sure because of natural economics, it will probably depreciate over time.
Yeah.
We won't feel that impact because us will be sitting with shillings.
Yes, yes.
And the interest we are earning on our dollars will be, because it's concessional funding, the interest we are getting on our dollars from Standard Bank is enough to repay the DFC loan. So the local projects will only pay the CARES loans to Stanbic. In CARES, so we have zero exposure to hard currency. And I believe this has been a very significant innovation. It took us over a year to work through, but we do believe that long-term capital investments in Africa will now be done in this way. That intermediates the dollars, because you have got, most of the capital in the world is in the developed markets. If we are going to attract it into Africa, we are going to need tools like this and innovations like this to actually be able to grow. So essentially, our transaction is now 100% de-risked from exposure to foreign currency fluctuations.
Key lessons there from 2013 and the roiling we saw of frontier market currencies.
Right.
The second point was, what does this transaction mean for your debt to equity mix as a company?
Yeah, that's a good question, because I think not everybody understands where the debt sits, how it sits in our business. Yeah. And in real estate, you have to be very careful with how you structure and manage debt. You have seen China's largest real estate developer, Evergrande, was collapsed by debt.
Yeah.
So you have to be careful how you do that. So where does this debt sit? First, our debt sits at the REIT levels. Acorn does not sit with this debt on our balance sheet. Yeah. This debt sits in the balance sheets of the REITs. Within the income REIT, the debt, the income REIT by regulation has a debt ceiling of 35% of assets value. The development REIT ceiling is 65%. So first we operate with those ceilings. They are regulated, we cannot go above those ceilings. Now if you look at the income REIT today, it has some debt we've put there, and it is local commercial debt. It's actually expensive, but it's about it's less than 15% of that 35% ceiling. I think, no, sorry, it's probably around 20%. It's less than 20%. Okay, so it's way below the regulatory ceiling. So you have some headroom there. We have headroom. Yeah. But why this DFC deal is very interesting is that the $90 million that will go into the income REIT will go in with the debt at a discount, the Kenya shilling debt. So let's say today the base rates are 15%. Yeah. The income REIT will get its funding, its shillings, but at a discount of maybe 5 or 6% to that. Yeah. Which means that now we are going to put cheaper debt into the income REIT, which means that it's not going to be dilutive to the equity holders as the local debt has been. So even that local debt, we want to retire it within 2 years because it's expensive. Yeah. You know, when you're paying 15%, but a property yields 7-8%. Yeah. But by bringing the cost of debt down for the IREIT, it will increase the yields that we're able to pay the investors in the income REIT. So that, and this facility of the DFC will provide 35% of the capital that the IREIT requires for the next 5 years. Okay. Again, dry powder. I talked about dry powder. Now, so the debt is very well within managed limits there. Now, the other 90 goes into the DREIT, which basically, because we've fully utilized the green bond, will be soon in the next few months retiring that bond and announcing the retirement of that bond. Yeah. The ABSA facility we took a few years ago, you may recall, will also be utilized. So now you need more debt. But it's what we do is, as we take more debt, we retire old debt. So that you manage your debt. And that's how we manage these facilities.
And you're keen on taking cheaper debt now?
Yes, cheaper debt is better because it enhances the returns to the investors.
I see.
Yeah, and so that's the debt structure in our business, and we manage it very carefully. We watch it carefully. As we take new debt, we repay old. Okay. So you will see the green bond being repaid, and then even the amounts that we'll have, we continue just repaying as assets are sold from the development REIT to the income REIT. That therefore creates a sustainable way to manage your debt.
So you're not over leveraged in this case?
No, not at all. Even the DREIT hasn't hit 65%. I think it's at 50-something%. I see. And as I said, and I think that's the beauty of doing, regulated real estate. Because as you have seen in Kenya, these unregulated things end up putting people in a lot of problems.
That's true.
But if you're operating with a regulated entities, which we are, you have to operate like the same way a bank operates. We are regulated by the Capital Markets Authority. So we have to operate within the regulations. And those regulations are there to safeguard the interests of investors. Yeah.
Okay. Yeah. You preempted my next point, Edward. You have a maturity in November this year, I think.
Yes.
For the avoidance of doubt, are part of this proceeds directed towards retiring that in any way?
No. That we will retire separately. We have a separate announcement. We'll be announcing it in a few months' time. I don't want to preempt, but we will definitely be retiring the bond, just a little early, not too early, because you want the investors who invested to get the full value for their investment. But we will retire that, and then we for now we won't do another bond. right now because we've gotten this money from the DFC.
I mean, you have bucket loads of financing.
Well, so right now we will maybe come back to the market to do another bond maybe a bit later. We'll see.
Okay.
Yeah.
In this market, you're known as the king of early redemptions. And it looks like you're headed for another early redemption with the maturity due in Nov. Why is this the case? I'm just curious.
First and foremost, I think there is a misunderstanding. The green bond was always structured so that it would have some early redemptions. It was the intention from day one when we took it to investors. And in fact, what that did, it de-risked the bond from the normal corporate bonds which have a bullet maturity.
Yes.
So you can see this, because we have been paying it off as we go, investors are not as anxious. Even the Kenya government has taken that approach with the recent Eurobond. It will mature in phases, not all in one go.
Yeah.
The typical bond that all matures in one day has its own risks that, when the date comes, but by retiring it in bits and pieces, it reduces how much. Right now we will have about just about, I think, 2.7 billion outstanding of the 5.7.
Yeah.
That's what's currently outstanding. So you see, it's less than 50% of the bond.
Yeah.
So now we have just that portion, less than 40% of the bond to retire.
It was part of the plan from the get.
It was part of the plan. Yeah.
Edwin, I know you're a busy guy. Let's dial down our conversation. I'm very curious as to whether, if the yield environment domestically had been different, because over the last 16 or so months the yields have been quite elevated, would you have gone this route to the DFC, or was this part of the plan right from the outset?
So the yield, the heightened yields, what they did is to really impact our local capital raising, because everyone was driving their capital to those infrastructure bonds and all of that, and therefore that's even why we had to put some debt into the income rate. It is those elevated yields that forced us to put some debt, because it was the yields were curtailing the fund, capital raising locally. So having said that, as I said at the beginning, this is concessional finance. You're not going to get this amount of money at that, at a low interest rate that we can get from the US DFC. So definitely, even if tomorrow we need more capital, we'd still look for that kind of concessional funding. Now, if you look at the needs for student housing, our plans over the next 10 years, actually the capital we need is almost $1 billion. So this will go a long way. It's like 70% of the $1 billion that we will require to get to those 70,000 beds. So it's, I think for now, quite a while, we will not, literally for the next maybe 5-10 years, we will not raise any debt for student housing. We'll now focus on the equity side.
I see.
Yeah.
And final question is, how are yields in the market looking like now from a return for your side as an investor? How is the market looking like? Because we've had a lot of conversation around a squeezed environment, disposable income is quite depressed. How is it showing up in your numbers?
For us, it doesn't come directly. It comes in, of course, in our cost of debt. That's where we will normally see the impact. I must say we've been a bit fortunate because the demand for student housing is high, and they are willing to pay because they are getting something quality. We've not seen that demand affected by what has been happening, because parents rank education very highly, and putting their children in a safe place is a big high priority. So it's not one of those you deprioritize when budgets start getting squeezed. You pay the tuition fees, you pay the accommodation. So for us it's not shown up directly, fortunately, but obviously by impacting the cost of our debt, it has then impacted returns, returns for our investors. But most of our investors are very long term in nature. They understand that this is a long term thing, and they need the diversification. Yeah. And I mean, because we continue to pay dividends and we will continue to enhance those dividends, then they're getting a good yield on their investment.
Yes.
Yeah.
Happy are those like Acorn who enjoy inelastic demand on their products. Thank you so much for your time, sir.
Not inelastic, but it's still strong. The demand is still strong. Yeah, let's put it that way.
Eric, thank you so much for your time.
Thank you.
I appreciate it.
Asante sana.
And congrats.
Thank you.
Asante.
Thank you very much. Yeah.